I think there's still a window for a soft landing.
Earnings are going to invert from negative to positive.
No more free money. Companies have to be more efficient.
Inflation's dying.
Productivity is going to be driving the next leg of the bull market.
Positioning remains too negative. People need pullbacks to get better position.
You had said something to the effect of, I'm the most bullish I've been in forever.
In years, at least since the global financial crisis. Investors are much more willing to pay a high multiple for a company that has improved their operational efficiency than a company that just borrowed a bunch of free money and bought back a bunch of shares. We're thinking about how to do more with less, which I think is really bullish for margins, for multiples. Companies are now refocusing on efficiency and productivity rather than juicing up earnings through levered buybacks and, cheap financing costs. You tend to see investors willing to pay a higher multiple for companies that are actually focused on efficiency. And companies are now finally focused on efficiency, and they have new tools. They have AI, they have automation. So I actually think there are a lot of reasons to be bullish about growth in the U.S. because I think that what we know now is we see more real returns, and I think that we're past this experiment of QE and zero interest rates and negative real rates and all of this really kind of unnerving stuff that has been hard to allow us to actually value equities appropriately. We're now at a point where earnings are still positive. We're seeing companies actually focusing on labor efficiency because labor inflation is showing up. So I think that we're at a point where productivity is going to be driving the next leg of the bull market.
No more free money. Companies have to be more efficient.
Companies have actually gotten very disciplined about leverage. And I think that's the lesson that everybody learned in '08. Even consumers have gotten disciplined. So if you look at the U.S. consumer and the U.S. corporate, they've basically locked in long-dated fixed-rate debt obligations. Back in '08, there were a much higher percentage of homeowners that had adjustable rate mortgages. Today, just 15% of homeowners have adjustable rate mortgages. Nobody's willing to walk away from their homes, and that's why we have this shortage of single family. On top of that, we've got consumers that are still relatively well capitalized. Maybe not as well capitalized as after they got a bunch of free money, but they still have relatively solid balance sheets. I think there is still a lot of room to get efficient. I fully expect to be replaced by ChatGPT or a robot.
Never. We are seeing a slowdown in job growth momentum. We're also seeing subdued inflation, higher oil prices, and the ISM services number looking high. We're going to have this big bounce in growth, and inflation is not going to go away. It's going to go away. This is an old cat bounce, and this cat's going to have less bounce in it going forward. The Fed would be very unwise to raise rates again just because of a short-term spike in enthusiasm in the service sector. Inflation's dying, but they didn't manage to slow down economic growth. I think there's still a window for a soft landing, but I think they should be very aware of the fact that there is a squeeze play going on consumers.
The fact that the market only pulled back 3% is a sign that positioning still is too negative. Positioning remains too negative, and people need pullbacks to get better position. I'm more worried about 2024 than I am 2023. We're seeing classic textbook case of what happens after a bear market. People get too negative, fund flows are too negative, and that's symptomatic of an early stage of a recovery. And it takes time until people realize, oh my gosh, I shouldn't have been selling, I should have been buying. Weekly fund flow still remains negative, and I think the return differential between money markets and equities is going to become more acutely painful as we get into the end of the year. Earnings are going to invert from negative to positive, and you get a huge amount of public work spending coming in the fourth quarter. All that is very positive, and that's why I think you get closer to 5,000. But what worries me, to your question, is we are right now, the monthly year-over-year inflation numbers are coming down, but that's going to get tougher next year. However, with an election year and the amount of stimulus that is coming in the fourth quarter, I have a hard time seeing the market substantially sell off. It seems to me the way the money market turns out not to be a great investment is we get a slowdown, but not a recession, at least next year, and the stock market hangs in there.